If you just clicked on this video, then you've probably heard of the letters GIC before, but you're not sure if it's actually something you should be investing in. Now, investing has a few key steps, and we kind of like to look at it like a flowchart. So first, you pick your investment platform and you create an account. Second, you pick your investment account where you'll actually buy the investments in. And then finally, you actually pick an investment to buy. And this step is where it can get a little bit more complex. Now, I say complex only because there's a lot of different investment options, and what you invest in is going to be based on a few different things. The reason that you're investing this money, how long the money will be invested, and also what you're comfortable with. So really quick example for you. If you're investing for retirement, then you're probably going to invest using a retirement account first, which is either an RRSP or a TFSA in Canada. Then, because the money is going to be invested for a long period of time, like if I'm 27, which I am, and I'm not going to be retiring until I'm in my 60s, that's over 30 years for the money to stay invested. In that case, I can choose investments that are most likely to make the most amount of money over the long term. So if I invest in something that doesn't grow very much over the next 3 years, it doesn't really matter. On the other hand, there's a new investment account in Canada called the FHSA, or First Home Savings Account, that's meant for people to use while saving for a down payment on a house. Now, if you're investing money that you're going to want to pull out and use within like 5 years, then you're going to want to make sure that you're both making a return in the short term and that you're not going to lose all of that money since you don't have a very long time to make it back. So what do you actually invest in?
Let's start off with an option that we haven't really talked a lot about in the past before. A GIC is a guaranteed investment certificate. And basically what happens is you put a set amount of money in for a pre-decided length of time, and you're guaranteed to get the money that you put in back afterwards, plus some interest. Let's break it down. So you know how a savings account works, where you put money in and you know that you won't lose any money while sitting in that account, and you also earn a specific amount of interest while your money's sitting in that account? A GIC is kind of similar. When you buy a GIC, you definitely won't lose the money that you spent purchasing it, and you'll earn a set amount of interest. But the big difference is that when you buy a GIC, you have to leave the money locked in that GIC for a set amount of time. So with a savings account, you can access your money whenever you want. With a GIC, you can. And with some GICs, you can't access your money at all. And with others, if you do try and take it out early, you'll likely have to pay a penalty fee or forego any interest that you earned. So why does this exist? What's happening to the money that's being locked in? Well, you're essentially lending your money to the bank or whichever financial institution is offering you the GIC. The terms of the investment state how long you're lending your money for, which could range from a few months to a maximum of 10 years. Now, the reason you're agreeing to lend your money is because you'll receive interest back as a form of payment. Typically, the longer that your money's being locked in, the more interest you'll make. So at the end of the time period, you'll get your initial money back plus the agreed upon interest. Now, the most obvious pro of investing in a GIC is that your money's guaranteed to grow, making it a low risk investment. The biggest concern that people have with investing is the possibility of them losing their money. But with a GIC, you know that the worst case scenario is that you'll get your money back. Now, on the other hand, the best case scenario is also exactly what you signed up for: your money back plus the interest you agreed on. These rates can range, by the way, depending on what the bank or financial institution is offering. Typically, GIC rates are lower than average returns in the stock market, but higher than savings accounts, including high interest savings accounts. So when would you want to select an investment option that is lower risk and does give you a return, even though it's lower than what you could get from the market over the long term? One example would be when you need the money you're investing within a short period of time.
A short period of time could be like when we talk about using the new FHSA. Now, with this account, you're investing money to put towards the purchase of a home within likely 5 years or potentially even less. So you don't have the time to benefit from long-term investments that could give you a higher return. And although there are ways to make a high return within a short time period, they also tend to be riskier options. And when you're looking to buy a house, you really don't want to risk having no money left at all. So a GIC might be something that you consider in this case, because you know that you're okay with having your money locked in as you save up for a few years. You know that you're not going to lose your down payment money, and you also know that you'll at least be earning some more interest than you would if you were just saving your money. So check, check, check. Now, if you're considering investments to buy when you're looking to invest for retirement, and especially if you're still young and you have decades until you're retiring, then a GIC might not be as hot of a contender for you. Because in this case, you have years to be investing. You also don't need the money for much longer than just 5-ish years, and you're also probably looking for returns that are higher than what a GIC typically gives. So that's the lowdown on GICs and when you might want to consider investing in them. Now we want to give you an example on where and how you can actually find GICs to invest in, and that's where EQ Bank comes in. We're really happy to be working with EQ Bank on this video to talk about GICs. And for anyone who somehow hasn't heard us talk about them before, EQ Bank was created in 2016 as the digital counterpart to Equitable Bank, which has been around since 1970. Now, their slogan is more make, less take, because their goal is to offer high rates and no fees on everyday banking. We've been using the EQ Bank Savings Plus account for the past few years, but they also offer GICs too. Now you can buy either registered or non-registered GICs. So basically GICs within a TFSA or RRSP or with a non-registered investment account. The rates offered vary based on the type of GIC you're going for and also the length of time that you're locking your money in for. Now they have options for 3 months, 6 months, 9 months, a year, 15 months, 2 years, and a bunch of other options ranging all the way up to 10 years. Now we're going to show you the current options and rates on the screen right now, but remember that they can change. Now there's a few other things that we want to note about EQ Bank's GICs. So there's a low minimum deposit of $100, and then just like your money held in the Savings Plus account, all GIC deposits are eligible for Canada Deposit Insurance Corporation protection. You can also buy up to 20 non-registered GICs for a maximum of $100,000 each, and you can also hold up to $500,000 in non-registered GICs overall. If you have any other questions about how EQ Bank GICs work, then please ask away in the comments below. You can also check out the link in the description box or also here on screen if you want to learn more, and a big thank you to EQ Bank for working with us on this video.
So what about when a GIC isn't the right investment option for you? Or if you're investing for a longer period of time and you want to see your investment returns grow higher than what the locked-in GIC rates offer? Well, there's other investment options that might make more sense for you in that situation. So in terms of investment options in general, let's throw up some options up on the screen. Obviously, we just talked about GICs, which is basically the next step up after saving in a high interest savings account. But then there's bonds, which similar to GICs are essentially you loaning money, but this time to the government in exchange for your money back plus interest. Now the key difference with bonds is that they don't have the word guaranteed in the title. So while you will get your initial investment back, making it low risk still, the amount of interest that you earn on top of that will vary based on the market. So you could end up with more or less of a return. Then there's stocks. Stocks are basically pieces of companies. When you buy a stock, instead of loaning money to the government or to the bank that you'll get back after a certain period of time, you're actually purchasing a piece of that company. You now own some of that company and there's no loaning involved. In this case, there's more risk because no one's promising you that you'll get your money back. Instead, you're putting your money into a company that you hope will make more money. If they do, then you as a partial owner or shareholder will get a larger return. Again, the risk with individual stocks is that your ability to make money is dependent on that one company succeeding. And if they don't, then you could lose your initial investment and not make any additional returns. Now, another option that we want to focus a little bit more on is a way to invest in the stock market but reduce your risk, and it's called funds. There's a few different types of funds: mutual funds, index funds, and exchange traded funds, but they all start out as a similar option. You can picture a fund as a basket filled with a bunch of stocks all put together for you. So instead of having a piece of one company, you could have a piece of, let's say, 50 companies all at once. And the reason it's less risky is because even if one of those companies loses value, as long as all 50 don't, then you won't be at risk of losing all your money. Now, on the other hand, if one company grows like crazy and all 50 don't, then you won't gain as much money.
By the way, the fund basket can be put together in two main ways. Either by a fund manager, which would be a person who's actually actively choosing what to put in the basket to try and make the highest return, or it can simply match a pre-existing market. Now, let me break that one down more. So when we say the stock market, there's actually multiple different markets depending on what types of companies we want to look at. So for example, the TSX 60 is a market that looks at the 60 largest companies in Canada. So if you buy a fund that tracks that market, you're buying a basket that has tiny pieces of those exact 60 different companies. And then the amount of money that you either make or lose is based on exactly how that market performs without trying to beat it. Now, this method is typically less risky than individual stocks because it's a fund, like we explained before, but also than funds that try and beat the market because historically they actually underperform compared to the market. Now, there's actually a lot of different funds that you can choose from, and in Canada, there's over 1,000 ETFs alone. So if you have any questions about how that process works and how you actually choose which fund you want to invest in, then ask away in the comments below. Overall, if you're investing for a short period of time, then you might want to look into GICs and if they're right for you and your investment goals. And if you're investing for a long period of time, then you might want to look into funds and if they're the right choice for you and your investment goals.
And with that, we want to say thank you again to EQ Bank for working with us on this video. And yeah, make sure you check out the link that's on the screen and in the description box below to hear more about EQ Bank's GICs. And yeah, make sure you check out the video next door, right, to hear more about EQ Bank's Savings Plus account and their new EQ Bank card. So yeah, make sure you check that out and we'll see you next week.